Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 10, the group B problems. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so we're working on assigned problem 10-55B. Let's see here. Let me get my pen. Okay, and it says here, analyzing stockholders' equity. All right, so McKay was organized in December of 2013. At the end of 2013, the balance sheet provided the following stockholders' information. Answer the following questions and make journal entries as needed. All right, number one, what does the 6% mean for the preferred stock? That's right there. Okay. After McKay Inc. issues preferred stock, how much in annual cash dividends would McKay expect to pay on 1,500 shares? Okay. Excuse me. So, what does the 6% mean for the preferred stock? That 6% right there is the dividend rate. Right. So whenever the shares of stock are, whenever there's a dividend, okay, that's the rate that's going to be applied for that portion of the dividend. So if the par value of the stock is $8, okay, and the rate is 6%, okay, that means each share of preferred stock will get a dividend of 48 cents. Right? So it says, how much in annual cash dividends would McKay expect to pay on 1,500 shares? Okay, so that's 48 cents times the 1,500 shares, and that would come out to about $720. Let's just quickly do the math. Times, oops, that's more 48 times 1,500 at $720. That would be the annual dividend. Okay, so that's a sort of a backward way. I probably would have said, if I took the totality of this question, I would have said, okay, what if we said what is the dividend, the amount of the dividend on 1,500 shares? I've taken that times the 6% and then times the $8 par, and that's would have given me $720. Okay, two different steps, same effect. Okay, pause the video if you have to write that down because I'm going to erase it. Okay, number two. For some reason, I seem to be moving slow today. All right, at what average price per share did McKay issue the common stock during 2013? Okay, so I'm looking at my common stock here. And my paid in capital. All right, so I basically have the $12,000 for the common stock and $33,000 for the paid in capital in excess of par, which gives me $45,000. Okay, then I take the $45,000 and that is divided by the number of shares issued and outstanding of 12,000. And so when I divide one by the other, I end up with $3.75. Okay, so that's how much the average price per share of the stock was. Okay, number 3. Were the first year operations profitable? Give your reasons. Okay, so was the first year operations profitable? All right, so we're talking about operations profitable. We're talking about our net income, because our operations are our revenues less our expenses, gives us a profit or loss, and that profit or loss is closed out to retained earnings. So I have to look at my retained earnings account, and since this is the end of just the first year, I can just look directly at that number there, and I could see that it's a loss of $4,000. So no, it wasn't profitable. Okay. Now, if there was additional data, okay, like let's say, for example, all right, since this represents 2013, let's just say in 2014, our retained earnings was, say, 7,000, okay? Well, then if we were going to answer that same question for the year 2014, we would have to take what we have in 2014, which is the 7,000, and we have a negative, a deficit of 4,000, a negative 4,000 from 2013. So I have to add that back in, and that means I would have had an $11,000 profit for 2014. Okay, if you didn't get that right there, imagine a timeline. This is 0. Not a timeline, a number line. This is 0. So at the end of 2013, we're at a negative 4,000 here. Right? This is 2013, and this is 2014. And at 2014, we have a profit of $7,000. Well, to get from this negative 4 to this positive 7,000, we have 4,000 here, which is what that is, and we have the 7,000 there, which is what that is, and that's the profit that we had during 2014. So I know that wasn't part of the problem, but that's the way you have to think about it. Okay. Number 4, all right. During 2014, the company completed the following selected transactions. Journalize each transaction. Explanations are not required. So A, issued for cash 5,000 shares of preferred stock at par value. Okay, so if they're issuing preferred stock, that means we're going to get cash, and we had 5,000 shares at $8 per share, which is $40,000. So we're going to debit 40,000. Okay, there's the $8 par, and again, it says 5,000 shares. So 5,000 times $8 is $40,000, and we will end up crediting preferred stock for the 40,000. Right, then it says issued for cash 2,000 shares of common stock at a price of $7 per share. Okay, so we're going to receive cash, right? And 2,000, we're getting 2,000 shares at $7. So 2,000 times 7 is 14,000. And of course, we're going to credit our common stock. And our common stock is $1 par right here. Okay, so 2,000 shares at $1 par is 2,000, right? And then if you've watched the theory videos or you did the exercise problems, or I think it was right around 38 and 39, I explained that the easiest way to go about this for the paid-in capital in excess of par, just take the difference between the two, because debits have to equal credits. So I have $12,000 of paid-in capital in excess of par. Okay, so pause the video because I'm going to erase it. All right, number 5. Yeah, if you didn't understand that, definitely go back and watch the theory videos, or like I said, I think it was exercise 1038, 1039, someplace in there. where I go into a little bit more of an explanation as to the idea behind backing into that paid-in capital in excess of par. Right, so it says here, prepare the stockholders' equity of section of the balance sheet at December 31st, 2014. Assume that the net income for the year was $75,000. Okay, so I'm going to cheat a little bit here. I'm going to expand this just a little bit, and I'm going to use this here and make this 2014. Okay, because I don't have space, and it takes time to just rewrite everything. Okay, so based upon the information that we had, remember right here we issued, because it was during 2014, we issued 5,000 shares of preferred stock at par. When we look at that journal entry, that means we have $40,000 of preferred stock. Okay, we also had, and from this journal entry, we had an additional 2,000 of common stock. So this is not 12,000 anymore. This is 14,000. Our paid in capital, all right? We go back to that journal entry and we add the additional 12,000 to the 33, so that's 45,000. Okay. And so our total paid in capital, when we add up those three numbers, is 99,000. Okay, now, just like I had explained back here about the first year operation being profitable, okay, well, if they had 75,000, all right, that means on a number line, right, this is 0, this is 75,000, and this is a negative 4,000, right? Okay, it says here, assume the net income was 75,000. Well, if I have a negative 4,000, whoops, I did that wrong. If I started out at a negative 4,000 and I add in 75,000, right? Well, I have to go through a negative 4 here, so I subtract the 4,000, and that means I'm at $71,000 between here and here. So this is 71,000, right? So this number becomes 71,000, and our total equity ends up being those two, or 170,000, right? Okay, the thing that one of the things that crossed my mind while I was writing that, realized that even though the problem is saying, it's asking you to prepare the equity section, realize that you had these journal entries, all right, which would have been posted to your general ledger accounts. And then from your general ledger accounts, and you also had the net income, the profit or loss, that was to make the closing entries, which would put that profit or loss to retained earnings. Okay, so you have all of these general ledger accounts with their balances in, and that's what you're using to create the stockholders' equity, right? So even though I'm working through the numbers, I'm just kind of like bypassing this process of journalizing and then posting to the general ledger accounts and then creating the balance sheet. Okay. So I'm just skipping over that process, but be aware that it is there, and you have to think through that depending upon the situation. I mean, it's telling you during 2014, because remember, we started out here at the end of 2013, right? And you have to take in, when you think about that timeline, right? Here's 12/31/13, right? And here's 12/31/14. Well, what happened during this period of time? These two journal entries happened during this period of time, right? So they get posted to general ledger accounts, and you create your financial statement. All right, so that's it for this problem. And I will, if you don't understand something, like I said, I recommend you go back and watch the theory videos, and then definitely watch number like 38, 39 from the exercises, 38, 39, 40, someplace in there, and If you still have any additional questions, feel free to contact an instructor.